All right, we're looking at futures a little bit lower, not moved by the inflation data this morning. 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, fresh PPI data shows that price pressures are abating while government shutdown risks add to trade war jitters.
In a Bloomberg interview, Commerce Secretary Howard Lutnick praises the UK and Mexico, but blasts the EU and Canada for retaliatory moves on tariffs.
And Ed YARDENI joins the chorus of Wall Street strategists cutting their S&P 500 targets. YARDENI says that tariffs heighten the risk of stagflation. Let's take a look at where these markets are trading. We actually saw a little bit of a bounce yesterday, but you're not seeing that follow through this morning, despite, as Matt mentioned, we had claims lower than expected. We also had PPI pretty much unchanged from what we saw at last month's reading, but you can see the S&P 500 down pre-market about 0.1%, a little bit more if you take a look at big tech. This week is shaping up to be another painful week for these markets. We'll see what changes the narrative, if anything. But then you take a look at the bond market as well. We've seen this rise in yields all week, and you can see that continuing a little bit today. 10-year Treasury yields higher by just about 2 basis points if you round up, and we're sitting at 4.30 on the 10-year yield.
Can I just say, I think there's a technical problem with my chart here, but if you push on your Bloomberg terminal, CHRT, you can see a wealth of charts. And there's a really good one by Phil Serafino, speaking of stagflation, about the Goldman Sachs stagflation basket outperforming the S&P. There's also a great one by Tasneem Brogger showing that defense stocks, not utilities and healthcare and staples, but
actual
war, really outperforming green or clean energy stocks. So a wealth of charts on CHRT Go on the Bloomberg, and I highly recommend checking out that function.
Maybe we'll pull them up later in the show. I'm interested in stagflation. As you and Katie know, I have been losing my mind over this YARDENI call.
Losing your mind?
Losing my mind. I didn't even shake you this morning, but really he's the last one to throw in the towel. He has been calling for the roaring 20s. Let's see if stagflation fears throw a wrench in that. Let's also talk about stocks moving pre-market. Looking at Intel rising more than 13, almost 14% pre-market. They're getting a boost after finally naming a new CEO, and that's going to be chip industry veteran Lip Bhutan. And next up, though, not as bright of an outlook here for Adobe, down 7% pre-market. They have disappointed. They have given a tepid outlook for revenue growth. It was a stock that already, as our own Bloomberg intelligence analysts say, was controversial. Also looking at U.S. beer companies like Molson Coors moving higher, with President Trump threatening 200% tariffs on alcohol products from the EU. Molson Coors up 1.2%. These have been kind of volatile throughout the year because, of course, input prices matter there too. Now, in the last hour, U.S. Secretary of Commerce Howard Lutnick spoke with Bloomberg. Here's what he had to say about EU's treatment of the U.S.
The EU has just so many years treated us so harshly. They just can't stop. Look, their tariffs are way up here and our tariffs are down here. How about relax? Let us balance it. We are your largest, most important trading partner. Treat us with respect and let's get a little balance. And Donald Trump is out there saying balance, balance, balance. April 2nd, he's going to describe his balance. We're going to do it.
It is absolutely fascinating what we've seen this morning, the threat of 200% tariffs on wine and champagne. But I did wonder, when we saw this retaliation from the EU, why not, instead of retaliate, reduce the 10% tariffs they have on autos and trucks? That's what Donald Trump's very angry about. And Europeans don't want to buy American cars and trucks anyway, so it would really be symbolic. Why not reduce the amount of tariffs they have on U.S. Dairy and meat? Because they make enough there. I just don't understand why continue to start a fight.
Well, clearly they didn't talk to you first, but I mean, that's not where we are in this global trade war, if you want to call it that. This is all about escalation, retaliation, and you take a look at the words that are being thrown back and forth. It doesn't seem like that world that you described is coming anytime soon.
You know, what's interesting to me is, in addition to the trade policies, what he said about the economy and the economic data, our surveillance anchors had asked him specifically, when is the bad data no longer reflective of the Biden administration administration and starts to reflect Trump policies. And he gave a time frame. He said Q4, not Q3.
Q4.
So I wonder if that means they're willing to take a bunch more pain until the end of the year. It has already been something that's been wiping out price targets, as we've been talking about for the S&P 500.
Yeah.
Maybe that gives them a little bit of cover.
Well, you think about YARDENI, for example, lowering his price target. He did say
Who's that?
Ed YARDENI.
He who coined the phrase bond vigilantes.
Yes, you might be familiar with him, dear viewer, but he lowered his price target. We had been waiting for that, as Sonali said, and he said that basically tariffs, they aren't this bluff negotiating tool that maybe we thought they were, but he did mention the 2026 midterm elections, that maybe that will be the tempering impulse on what we're seeing right now.
That's the biggest reason to be watching what's going on in Washington. Everything can change, or a lot can change in a couple of years, and stagflation, as we know, Matt, has been a nightmare scenario for the Federal Reserve if they were to hit it. So we'll talk a little bit more about what that would mean.
All right, let's talk about this with someone who knows what the Federal Reserve considers a nightmare and not. We had inflation data within the last hour, still probably Biden's economy inflation data, but we'll break down that story with Michael McKee. He joins us here on set. Mike?
Well, sweet dreams for the Fed with the PPI numbers today because they're pretty good, although yesterday the CPI numbers were good, and they were Trump numbers, according to the administration. So this may be Trump numbers, not Biden numbers. PPI headline comes in flat for February after being up 0.6% in January, pushes the year over year down 3.2%. Look at that, a 0.5% drop in the headline year over year. Core X trade down 0.2%, or up just 0.2% rather, and on a year over year basis, 3.3%. A point on that, though, the February drop there is due to margins for wholesalers and retailers. They shrank. So maybe some under the hood problems for retailers going forward in this PPI report. The other thing I want to mention about PPI is that egg prices were up 53.6%. Donald Trump tweeted a short time ago that egg prices are down, America is back. He's wrong. Egg prices are not down. Also, scrap steel was up 8.6%, steel mill products up 2.7%, tariff anticipation. The other number out this morning is jobless claims. Almost no change there, 220,000. And federal initial claims fell a little bit, 1,580 from 1,634. So not so bad. The number we want to watch from now on, guys, is continuing federal claims. They were over 8,000 this week. As the damage mounts in Washington, that number is going to go up and give us a much better sense of how many people have actually lost their jobs in the weeks going forward.
Yeah, that's why I feel like next month is Trump numbers when it comes to labor, when it comes to inflation. We're going to start seeing those things hit. At least that's my take. We'll see if it bears out in the numbers. Mike McKee, thanks so much for joining us. Let's talk about this to Wei Li. She joins us from BlackRock, where she is Global Chief Investment Strategist. And Wei, certainly if these aren't Trump numbers on the economy, these are Trump numbers on the markets. What do you think about the hit the equity indexes have taken?
Well, what we have seen so far is that U.S. exceptionalism is coming under pressure, and specifically U.S. growth exceptionalism is coming under pressure, and U.S. tech exceptionalism is coming under pressure. But let's be very clear, the current growth data does not point to us heading towards a recession. You look at the robust job creation, you look at the still very good kind of earnings expectation for this year, 12% expected for this year, revised down from 14% at the beginning of the year, but still consistent with slightly even above trend trajectory, right? So the current data in terms of growth does not point to recession. But of course, if this extremely elevated uncertainty were to persist, there is a path towards there. But we do think that the sharper the economic pain, the sharper the market pain is going to force a quicker kind of journey towards policy clarity, and that itself may well lead to some of this policy uncertainty, risk premium being priced out. So that's on the growth exceptionalism. Currently, the U.S. economy is not doing so bad. Right. And then in terms of tech exceptionalism, markets obviously have sold off, but in our assessment, it is not commensurate with worsening fundamentals. You look at CapEx indication, it's even up 40% versus what was a record year last year, despite DeepSeek and profits and margin and earnings expectations. They haven't notably dropped either. So there is a bit of a disconnect. And I think the very elevated policy uncertainty is the reason, together with deleveraging and some of the crowded positions being washed out.
So let's put this together and how investors should be thinking about their portfolios right now. You mentioned this policy uncertainty actually could force clarity when it comes to maybe some monetary policy. But you also mentioned maybe the fading exceptionalism of American equities and American tech. And if I put that together, what does that mean for how I should be weighting the U.S., for example, versus Europe versus maybe Asia?
Well, we recently closed European equity underweight because we see this market being so unloved, so underowned. Now there are momentum catalysts for that to turn around that can go on. So we're neutral European equities. We're keeping our Chinese equity tactical overweight as well. A similar story applies there, but we're not downgrading U.S. equities at this juncture because the price action, like almost 10% from peak to trough at this point, is overpricing recession risk in our assessment. So we're also keeping our U.S. equity overweight. You look at tech specifically, last year we went overweight tech since mid-2023. And for most part of that journey, I hear investors and clients come to me and say, well, I don't question the tech story. I don't question the AI transformation, but it's just price is too much. It's gone up too high. Now, fundamentals haven't deteriorated and price is quite a bit lower. And all of a sudden people are getting very anxious about it, right? So I think for those that do have the luxury of not having to de-risk at this juncture, there are good opportunities right now. But I would say, though, markets pricing in terms of treasury, market pricing as though it can be a good recession diversifier or portfolio diversifier that is under appreciating the sort of environment of high debt and inflationary pressure that we're in. So we would lean against treasuries acting as a recession diversifier in this environment.
So, Sonali, a lot to dig into there, but the tactical overweight in China kind of reminds me of what we were talking about with Carson Block yesterday, that China is a trade. Don't get married to China, but you can date China.
Yeah, no, it's very interesting because, of course, China has its own uncertainties on a macro basis. As far as the macro basis in the U.S., you also said that you are not underweight the United States, but you look at strategist after strategist lowering their price targets. You look at an S&P 500 that is not only down on the year, but has struggling for now many weeks to break back sustainably above 6,000. So my question is how much more downside risk there is before things get better?
That's a great question. Let me clarify a little bit. I think in the near term, the crowding position getting washed out, and there are still some of that in the system despite the significant deleveraging that we have seen. So that dynamics can still put pressure on U.S. equities, and certainly we're seeing extraordinarily elevated level of policy uncertainty, and that should warrant a higher risk premium at this current juncture. But over the 6 to 12 month horizon, which is our tactical asset allocation horizon, we do believe that some policy clarity will be forced out of market pain, and that should lead to some of that risk premium getting priced out. And ultimately, we're in an age of populism, and what happens in Wall Street and Main Street should matter. One cannot tolerate pain for too long. So it is a matter of time horizon, I would say, and the fact that current market disconnects with worsening fundamental, which is not a huge amount, is why we're not downgrading our U.S. Conviction at this point, but very much recognizing that there are very good reasons that markets could come under pressure in the very near term.
All right, that's a good place to leave it. Really great to get some time with you. That is Wei Li of BlackRock. Meanwhile, a quick check on futures. You can see those losses in the pre-market sticking around. The S&P 500 down about 0.1%, a little bit more if you take a look at big tech, which has really been the pain point in these markets. The Nasdaq 100 currently off by about 0.3%. The Russell 2000 holding up. This has kind of been a head scratcher this week. It's been outperforming a little bit, but it hasn't exactly been hard when you take a look at the pain that has been felt in the big benchmarks, Matt.
I wanted to show you a chart I found this morning in the JP Morgan story, which I thought you would find particularly interesting because of your side gig on the ETF program. So this is the NASDAQ 100, right? And we're looking at it over a 2-year perspective. On the bottom there is the volume in the queues. And every time the volume in the queues gets well over 75 million shares, it seems to be a turning point for the NDX. And I just think it's fascinating. Literally every time going back to September of 23, maybe it happens again.
It's not only fascinating. I want to point out that our later guest, Stuart Kaiser, has been recommending that you buy puts of the QQQs to hedge as well. So a lot of trading around it. Yes, selling, but also protection on the downside.
Yeah, I will say, going back specifically to volume, which this chart is highlighting, it's interesting because if you bring it back up, you can see that line and you can see we don't breach it that often. But I will say, if you take a look at the Qs, if you take a look at SPY and you think about the volume, it hasn't been crazy. We're not seeing 2020 levels. And a lot of folks have pointed that out to me and said, this is an orderly sell-off. What we're seeing right now doesn't exactly qualify as panic.
Silver linings.
Exactly. We'll continue to watch that one. But coming up, Intel appointing its next CEO, an industry veteran. We'll take a look at the company's future next. This is Bloomberg.
President Trump threatened a 200% tariff on all wine, champagnes, and alcoholic products from the EU if the bloc's 50% levy on American whiskey, Kentucky bourbon, isn't immediately removed. European spirits and drinks makers dropped on the news, and Commerce Secretary Howard Lutnick says he'll talk to his EU counterparts today. Lutnick spoke earlier on Bloomberg Surveillance.
The president has made it crystal clear that he finds this tit for tat really abusive and aggravating, right? His objective is steel and aluminum tariffs. Let him build his steel and aluminum business in America because that's important. And then, you know, they say, okay, we're going to tax whiskey. And look, I find all this back and forth really off the topic. The key topic is rebalancing American trade. We're going to spend lots of time together, you know, but the president was totally annoyed that the Europeans did this. And so you're going to hear back from someone who emotionally cares about America. He cares about America, and he wants to take care of Americans. And why are Europeans picking on Kentucky bourbon
Secretary
or
Lutnick,
Harley Davidson motorcycles?
Are you saying this is an emotional response?
It's disrespectful.
Are you saying this is an emotional response, or will we see 200% tariffs on wine, champagne, and alcoholic products before April 2nd, when the president says is the big one, and we're going to get the reciprocal rollout?
Well, the joy of my job is that Donald Trump makes the decisions, right? And the people around him, we talk to him and we advise him. April 2nd is when we do reciprocal tariffs. And he's called out these products. He wants these countries to respect him. And all this showed you is that Europe and Canada do not respect Donald Trump and do not respect America's ability to build its steel and aluminum industry, which is vital for national security, whereas you watched Mexico and you watched the UK be pragmatic and thoughtful, and the way we're going to deal with them is going to be better. So these are just black and white things. Why would you put against steel and aluminum, would you say Harley Davidson motorcycles and Kentucky bourbon? It's just illogical. I think the president is saying, look, I am going to respond always bigger and always stronger. We will talk together. You know, he wrote that tweet this morning. We will talk together. If that's what he wants to do, we will do that. But the answer is April 2nd, a thoughtful approach to reciprocity and national security of those products he's called out. We're going to increase our domestic production of those and have a reciprocal model. And hopefully when I talk to the Europeans, they'll realize that they should take these things down, cool these things out, and let's properly negotiate.
And that was U.S. Commerce Secretary Howard Lutnick earlier on Bloomberg TV. We'll be bringing you parts of that interview throughout the morning. But let's turn our eyes to Intel. Absolutely surging this morning after the company announced last night that Lip-Bu Tan would be its next CEO. Tian is a former head of Cadence Design Systems, a respected semiconductor veteran, and just recently he was on Intel's board, so now he's back. Here with more is Bloomberg Technology's Caroline Hyde. Caroline, let's talk about what exactly he's going to do, because his early signal is that he's going to stick with Pat Gelsinger's plan to make chips for other companies, but I have to imagine he was brought in for a reason.
And many feel if he can't do the job, then no one can. And that's what Bernstein, Stacey Ragson, is currently saying. He is a veteran of venture capital. He's invested a lot in Chinese chip makers, SMIC in particular. We've seen the fact that he's turned around a company before. Cadence Design Systems was in a difficult time in 2009. And this is a company that helps you build the blueprints of designing incredibly sophisticated chips. So he understands the business model entirely. But from his first note to his employees, it does seem that, yeah, he's sticking with the foundry business. He's sticking with wanting to re-improve them as a product manufacturer. This is a company that has lost 50% of its market capitalization over the last 12 months. It is still in 70% of all PCs and servers. It is integral to the overall tech ecosystem, but it is below the top 10 chip players out there in terms of market cap. They need to resuscitate their brand. They need to resuscitate their product innovation, particularly on the AI accelerator front too.
You know, one thing about this whole thing, the Wall Street reporter in me wants to ask you about his capacity as a deal maker, but the tech curious person in me wants to ask about his tentacles across the technology industry. He was on the board, for example, of Celestial AI, which yesterday was on your show that I moonlit on for a second. Learned a lot. It's a company that has, for example, relationship with the Porsche holding company, was talking about the ability to use more AI in cars. Do you think that this is a new CEO of Intel that can kind of push the AI story in the United States in a far bigger way than maybe meets the eye?
I think he's been on the board of Intel, and he left citing needs to reprioritize back in August of 2024. Now, other reporting shows that his frustration with bloat and with a lack of ability to reorientate towards this new artificial intelligence future that all of us talk about so much. Think about how much AMD has stolen on their march when it comes to PCs, with the new future of AI PCs, when it comes to servers, and ultimately they have lost most of the shining light to NVIDIA. They did not manage to pivot into the generative AI space, did not get into the GPU offering. And overall, we see the Gaudi offering just falling flat. So yes, I think the fact that he has been on boards of generative AI companies, he understands Chinese manufacturing as well. All of this is just going to speak to a really holistic view, I think.
You know what I think about a lot is the great state of Ohio.
Yeah. I barely think you think of anything other than.
And, well, Intel was planning a $30 billion factory in central Ohio, right near my hometown of Granville. Go Blue Aces. And it is on hold now, and really the whole CHIPS Act funding is in question now, right? Yeah. Because Donald Trump wants to stop that. How much money has Intel gotten already from the U.S. government, and how much will they miss out on if that is killed?
They're promised $8.5 billion. And Pat Gelsinger, before he was ousted, came on Bloomberg Technology, came on across our networks, and was frustrated that he couldn't get the money quick enough. Of course, the CHIPS Act money comes in installments. You have to hit certain landmarks in terms of boots on the ground, in terms of things that are constructed, in terms of overall foundry manufacturing to get the money in.
Apparently in terms of, like, diversity targets as well, and, like, Biden-era regulation.
Someone speaking from the mouth of the new administration. It sounds like, yeah, there is a
that's
frustration.
Actually, I'm just talking about the actual rules. It doesn't matter what administration, right?
That is exactly why there has been this pushback from Trump and others about the CHIPS Act, because they felt that in many ways it was too environmentally focused. It was ultimately was bringing in other areas of DEI that they felt wasn't really core to getting foundries out and manufacturing as quickly as possible. Remember, there's reporting that they were trying to have negotiations with TSMC to potentially try and take some of these foundries off the hands and start building themselves. So really interesting time.
Caroline, up against the hard break, but fantastic reporting as always. Tan, of course, has a big job ahead of him. We'll continue to follow that story. But coming up next, it's the opening bell. We'll walk you through all the market action with Stuart Kaiser of Citi next. This is Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. On a day when we had inflation data in the form of the PPI really coming in cold, you would expect these arrows to be green, but they are not. We see futures down on the S&P. NASDAQ futures also off. For Katie, Russell 2000 futures are doing well, and apparently those small caps are slightly outperforming. But you hear the opening bell there. On the New York Stock Exchange, it's PR week. So a lot of journalists are going to know these people. I'm looking for Christina Alessi. I don't see her there, but I know she's down on the floor. Down at the NASDAQ, you've got a SPAC, Maywood, ringing the opening bell. And they've only been trading for a few days, but still outperforming the broader index with a gain of 1%. In terms of the major indexes in the live cash trade right now, Katie Greifeld, what are they doing?
Well, Matt Miller, you make a good point that we've gotten really good news on inflation this week. You think about CPI coming in cooler than expected. You think about PPI just this morning, pretty much unchanged from the prior reading. It's not helping out these markets right now, and I think it's really telling that this buy the dip impulse has faded in this market environment. We'll get into that in just a bit, but you take a look at where we stand right now. The S&P 500 losses deepening as trading kicks off, down about 0.3%, even more if you take a look at big tech with the NASDAQ 100 off about 0.4%. I've been keeping my eye on the small caps. They've been the outperformer this week. They're still the outperformer right now at this moment, but the color is also red. Let's find some good news and look under the hood and talk about Intel. As we were just discussing, it's surging this morning after incoming CEO Lutnick signaled that he's sticking with the strategy of making chips for other companies. That, of course, is Pat Gelsinger's plan. We'll see how he breaks from some of those routes that his predecessor laid, but you can see that Intel right now higher by about 12%, Sonali.
You left me with the bad news. I'm keeping an eye here on Adobe, Katie, because it's disappointing investors with a revenue outlook that's below expectations, and that's despite a recent focus on monetizing new AI features. You have Adobe down more than 9.6% at the market open, Matt. It's been a bit of a tough story for Adobe, relative underperformer in the world of AI.
Getting decimated, Adobe. I know a guy who loves Adobe, the suite of Adobe software.
What's his name?
Joe.
Yeah, he's a good guy.
But I don't love it. Adobe is one of those things, you subscribe to it by accident one night, and then you try and quit for like 2 years.
Yeah.
And they just keep sucking money out of your account.
You'll have to talk to that Joe about it, because I think that he keeps hitting renew.
You know, I was kind of excited about your charts. I'm excited that Dollar General is up today.
Yeah, what, did I have a chart?
You did.
On Dollar General?
Well, you had the stock chart. It's moving higher.
I've got American Eagle here as well as Dollar General, yes. American Eagle dropping, giving a weak forecast, the retailer anticipating near-term headwinds from tariffs, and Dollar General gaining after forecasting sales will grow in the high end of expectations.
Listen,
always moving me along, Sonali.
Yeah,
move me along. You know what?
Don't
waste any time talking. Get to the next.
Get to the movers.
Yeah. All right. Another day, another strategist cutting his S&P price target. Ed YARDENI lowering his best case target, saying President Trump's tariffs have heightened the risk of stagflation. You can see here it has dawned on us that President Trump's tariffs aren't negotiating chips. They jeopardize U.S. inflation and economic growth. Let's take a deeper look with Bloomberg's Alex Semenova. Alex?
Hey guys, so Ed YARDENI of YARDENI Research, a notable perma bull, is actually scaling back his outlook for U.S. equities for this year. He sees the index going only to 6,400 compared to his previous target of 7,000. And of course, we had Goldman Sachs earlier this week also lower its forecast for the S&P 500. But on the other hand, you have JP Morgan cross-asset strategists saying that this correction is actually overdone based on signals from credit markets. Credit markets have been right over the past 2 years on multiple occasions at a time when equities and bonds perhaps overplayed the risk of a slowdown. So that's offering some much needed reprieve from JP Morgan compared to what Goldman and YARDENI are saying.
Yeah, it's interesting that JP Morgan took that stance, because you can look at these markets and say one is right, and it seems like JP Morgan is saying it's the credit markets that are right now. But I want to talk about another story that you have out on the wire this morning. I referenced it a little while ago, basically that the buy the dip impulse that has really supported this market for the past 5 years, it seems like it's faded right now, that appetite just isn't quite there, Alex.
Yeah, Katie, investors have really been able to flex that dip buying muscle over the past 2 years. In fact, through last July 24th specifically, the S&P posted its longest streak since the global financial crisis without a 2% drop. 356 days. So it was a market that was going up, and investors got comfortable stepping into any pullbacks and being rewarded for it. But anyone who's done that in the past 3 to 4 weeks, as we get these sporadic tariff announcements, has really been punished. As you can see today, of course, we got a bounce yesterday, and we're back down today.
All right, great reporting as always. That is Bloomberg's Alex Semenova. And let's keep the conversation going now with Stuart Kaiser. He is Citi head of U.S. equity trading strategy. And let's start right there. Buying the dip. You actually said late on Tuesday that we are not dip buyers here. You also recommended some tactical trades, but let's start just with that. Why not?
Well, I mean, look, why we're not buying the dip, 3 core reasons. Number one is just the assault on kind of core long positions and momentum stocks has just been kind of nonstop for the last 6 weeks. To be fair, Tuesday was probably the best day of the week in our view in terms of market internals, where you had a down S&P tape and you had tech and momentum stocks kind of performing pretty well. But we don't think that sort of position de-risking is 100% done. We do think we're later innings, but we don't think we're quite there yet. Second reason, the Trump and FOMC puts, if they exist, I think are much further out of the money than the market's anticipating. And then lastly is economic data. PPI, I think, is a good example today. Anytime over the last 2 years, the softer inflation prints you've got in the last 2 days would have been welcomed. The market's worried about growth slowing down now, so they've kind of flipped the script and are reading those softer inflation prints as evidence that demand is softening, as opposed to the good news that might be associated with the easing inflation data. So 3 reasons.
One thing that's been difficult for a lot of investors in this market is capturing the low, and then capturing the low in a volatile market where that low kind of keeps changing. What would give you confidence that we've hit that barrier of the pressure really ending in this kind of rotation of selling that is coming from everything from momentum trading to people that just don't think that this is the right time to buy a big tech?
Yeah, look, I think there's 2 things. One, on the data side, is really all about the labor market. We did get decent news out of the labor market last week, though the internals of that jobs report were a little bit on the soft side. And second, it's just going to be price action. As I mentioned, I mean, the last 2 days have been positive in the sense that those tech, AI, momentum stocks have traded higher, in particular on Tuesday when they rallied in a down tape. We're going to need to see a little bit more evidence of that. I mean, our trading desk has used the term buyer strike, for most of the last 2 weeks. I would say the last 2 days, we actually have seen some buyers starting to bottom pick a little bit. The problem is a day like today is going to be very, very frustrating for them. Not seeing follow through on yesterday's recovery, I think, is going to make people a little bit cautious about trying to dip buy again.
I thought only the bond guys did that, Matt, a buyer strike.
Well, if they did, they would be called bond vigilantes.
That's true.
And that would bring up Ed Yardeni again. He cut his target from 7,100. Was it 7,000? 7,100? It was 7,000. But now it's still 6,400, right? And I think Scott Kroner
next year as well.
But it's higher still, is my point, right? From here, it's another 15% higher. Scott Kroner also has a target that's another 16, 17% higher, right? Everybody, even those who have lowered expectations for, say, the first half, still have higher targets year end. What gets us there? Is it the TCJA extension? Is it, the end of the tariff war? Does the Trump administration get sensible?
Yeah, I think it's a combination of all of the above. I mean, coming into the year, I think you would have argued strong underlying fundamentals, really bad risk reward around those fundamentals because of valuation and Trump policy, et cetera, like that. Sitting here today, what is the kind of key to unlock? I think the next bit of upside would be success in the budget and tax negotiations, I think. U.S. economic data doesn't feel like it's going to get us there. Consumer sentiment has been dented considerably. If you were to get, a budget agreement that had some spending cuts, but also did extend those tax cuts, I think the market would kind of respond really positively to that. If you're hoping tariff wars are going to end, I think you should be patient because I don't think you're going to get, much an end to those negative.
But we're not going to get a recession, right? I mean, JP Morgan was out with, I think you sent me the story.
Yeah,
they said that the stock market is discounting a recession at 33%. Bonds are showing it at 9 to 12%.
Specifically the credit markets. Corporate spreads are very narrow right now.
Yeah, but the credit market, I'm not sure is the best signal right now for equity markets. The difference today between previous quote unquote crises would be that who holds the debt, right? This is government debt. It's not really on the corporate side of the ledger. Corporate balance sheets are still really, really healthy and really, really clean. So I think that's why we haven't seen a significant blowout of spreads. That said, flows through our desk the last week have been very, very heavy to hedge in HYG over the next 3 to 6 months. So I think what the bond market is saying is maybe if the equity markets are 33 and we're at 10 or whatever numbers you're using, that gap has to close. And if I'm paying very, very low implied volatility to hedge in the credit space, maybe that's a good value kind of recession protection for me.
Yeah, and I was taking a look at some of the ETF flows this morning, and you definitely see a bid coming out of corporates. But you are head of trading strategy. We talk to a lot of long-term investors, and they tell us to calm down. But let's get tactical here, because you recently recommended some hedges in the form of QQQ puts. You also recommended puts on XRT, and then in the bond market, IEF basically calling for calls there. Walk us through how those different hedges fit together.
Yeah, I mean, IEF calls is basically the view that U.S. economic growth is slowing and you're going to get the 10-year yield lower on that. This is an area where we've gotten pushback from clients all year that we actually think lower 10-year yields are negative for U.S. equities, because to get those yields lower, you need negative economic growth to push you there. So if you are of the view that U.S. economic data is going to slow, unemployment rate is going to rise, you're basically positioning yourself for lower 10-year yields. Qs is very simple. That's just simply positioning. If people have to sell, what do they own? They own large cap tech. You might as well hedge that directly. The XRT and potentially small cap, I think, would fit in the same category of if you are worried about consumer sentiment and U.S. growth, then the U.S. consumer has kind of been the white knight of the global economy for the last 10 years at least. So if you were to see real risk there, you want to, again, hedge that, through the retailing side. So it's really, all of these are different sort of varieties based on what you think is the chief risk to U.S. equity markets. The last 6 weeks has been positioning. So I think Qs has worked the best. If you are worried about recession, I think, again, it's 10-year yields lower.
Stuart, it is always great to see you. Always a masterclass when it comes to positioning when we speak. Come back soon. That is Stuart Kaiser of Citi. I do want to go back to Intel, because we've really seen momentum pick up just as markets open. Intel shares jumping 18% at one point. That would be the biggest one-day gain since March 2020. We've come off that level a little bit, but still higher by 16.5%. I just want to pull up a year-to-date chart of Intel versus NVIDIA. I know that I'm going to have a lot of people, maybe Matt Miller included,
it's a $100 billion company.
To zoom out, but you take a look at this reversal in fortunes just in the early months of 2025. Intel up 22%, NVIDIA down 13%. I don't think a lot of people saw that coming. Yeah, the PE still, though, is the ratio that we should watch at in a market that is now looking at valuations. What's interesting to me, we did this with Starbucks. How much money?
Wait, what is the PE? I'm looking at 39 on NVIDIA.
Right, and so the estimated PE, we don't have it on the Bloomberg terminal. I'm wondering it's because of the earnings story that they have there.
I see 50 as the estimated PE on
Estimated,
Intel.
right.
Yeah.
And so, price to earnings ratios here correcting. But another point I want to make out is Liputan, $16 billion man. That's how much has been added to NVIDIA's market cap, not NVIDIA, Intel's market cap just this morning on the heels of that pretty stunning rise.
Making it a $100 billion company.
There you go.
Compared to what for NVIDIA?
A gazillion?
2.8 trillion.
Right, I didn't have that off the top of my head. Pretty staggering. Anyways, coming up, we're going to talk about shelter from the storm. Microsoft snagging a Wall Street upgrade thanks to its consumer exposure. Details on top calls next. This is Bloomberg. All right, welcome back to Open Interest. Taking a look at stocks accelerating to the downside right now. The S&P 500 now down 0.4%. A lot of interesting action when you take a look at the NASDAQ 100 down about 0.7%, even with this huge rise that you're seeing in Intel. Its biggest day since March 2020, not helping out the benchmark right now. It's the small caps, actually, that are still outperforming for the day. Very small gains, but that's all you need in this market. The Russell 2000 up about 0.1%. Meanwhile, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Wells Fargo getting raised to a buy over at RBC. The analyst says that the stock's weakness provides a good entry point. Next up, we have Microsoft getting raised to a buy over at D.A. Davidson, with the analyst saying that it has the least consumer exposure compared to its big tech peers, making it best positioned for a slowdown. And finally, American Eagle getting downgraded to a sell over at Barclays, with the firm citing macro headwinds that are weighing on teen spending. Now coming up, private capital firms under pressure. We'll speak with Goldman's Alex Blostein next in our Wall Street Beat. This is Bloomberg.
Wall Street more and more is adopting unmarked assets. Private equity, venture capital, private ABF, private credit. Those things aren't marked. Mark to market is what creates the need for honesty. And to me, the next big risk is, in this sea of subjectivity, in this changed environment, will investors really know what they own? Or does everything become Silicon Valley Bank and Lehman Brothers?
Strong words. That is Jonathan Lewinson of Diameter Capital Partners speaking with me about the next big risk. And that brings us to the Wall Street Beat, because the large alternative asset managers that are publicly traded have underperformed the broader market since the start of the year. And in a recent note, Goldman Sachs senior analyst Alex Blostein wrote that the sharp decline has largely been a function of rising earnings risks to capital market sensitive earnings streams. Alex Blostein does join us now here on set. I mean, these stocks are just so reflective of me to how high the hopes were for an IPO and M&A boom that never seemed to materialize. We're almost through a quarter of the year.
Right. Well, thank you for having me. Good to be with you. So you're certainly right. I mean, the stocks came in really heavy into the beginning of the year with expectations for capital markets recovery just starting to finally pick up. That is not the environment that we're in so far this year. So in the note, one of the things we pointed out is that if you stress the earnings stream for all these companies, there's about a 15% earnings risk to where consensus is for 25, 26. But importantly, these models have also become a lot more durable. And one of the things we keep pointing out to folks is that the management fee streams for these businesses have been growing through effectively every capital market cycle. So when you go back to 2018, 2019, when you look through COVID, when you look at the regional banks crisis, the management fee stream has been very durable, predictable, and growing. That's the part of the model that we're really focused on.
Well, I think this note captured a lot of people's attention because private markets are inherently private, and there's a lot of skepticism and curiosity about what it actually looks like. And the FT had a great article about it. And our chart was private credit underperforms. Theirs was in private markets, no one can hear you scream, or something to that effect. So when you take a look at the stock performance, is this really just these stocks coming off after a really hot 2024, or is there something at work in private markets?
Yeah, so we don't think there's a systemic risk in private markets. And when you look at how the asset class performed through other recessions and through other downturns, inevitably there's going to be slower returns, but the asset class is done much better, and actually much better than a lot of the public asset classes. So the thing that we keep focusing on is that the business models for a lot of the alternative managers have evolved drastically. And Sonali, you and I talked about a bunch in the past where the reliance on carried balance sheet income is what's likely going to be most scrutinized. When you look at the other end of the spectrum, and when you look at management fees, when you look at fee-related earnings, we think that continues to grow. And look, the fundraising environment could get tougher because people obviously expect to get some of the capital back. That could slow down some of the fundraising. But when you look at some of the larger addressable markets, whether it's the wealth channel, whether it's the insurance channel, that all continues to grow.
I can understand there's no systemic risk now because, you know, these are the smartest people on the street that are putting these deals together. We talk with Lewinson, we talk with Lipschultz. You know, these are very intelligent dudes. But if the popularity of these products grows, right, the underperformance year to date notwithstanding, does that present a risk? You know, do regulators or does somebody have to step in and make sure that this market doesn't get so popular that they're lending money to everybody?
Right. So let's unpack that a little bit. Right. So the risk that people will mostly talk about is on the wealth side. And that's probably what the regulators will be most concerned about. That space has been growing rapidly, but put in the context, it's about $300 to $400 billion in assets as a whole. So in terms of the size of the market, the size of the kind of other invested product, it's actually still quite small, with the average allocation towards private strategies within wealth still running in kind of like a low single-digit rate, right? So in terms of the amount that's at risk, it's actually still quite manageable. The problem becomes when it comes to liquidity. And when you don't have liquidity in the system, and when you have a lot of withdrawals from these funds, that's where it becomes an issue. That really hasn't been the case, and obviously there's a 5% limit for a bunch of these funds. So unlike traditional funds, you can't get your money out as quickly.
So,
unless you have Apollo backstopping you, right?
Well, yeah, we'll talk more about that. But, you know, the size of the drawdown you've seen this year, Apollo, KKR, Blackstone, all down 20% or more. What does that say about how investors feel about the assets that they hold? There's a lot of question, you heard it from John Lewinson at Diameter, about whether these marks are not keeping up to what you're seeing in the public markets.
Yeah.
If you're seeing this much pain, could it be possible that you're not seeing more pain in the private markets?
Yeah, I mean, listen, like, you will see more returns of compression in private markets if this continues, right? Obviously, these are not bulletproof strategies. There's always going to be a lot less volatility in the private strategy versus what you see in the public market. In the public market, you also have to deal with the dynamics of liquidity, right? Like, if you get a lot of withdrawals from even mutual funds or ETFs, that's going to put pressure at a time where the banks might not be intermediating as much as they used to. So there's a lot of technical things at play as well between what you're seeing on the screen and the returns of some of these products.
We have a minute left with you. You mentioned ETFs. I want to talk about the State Street Apollo Private Credit ETF. I'll actually be speaking with State Street's Anna Paglia at about 12 p.m. today about that. It's been live for just about 2 weeks. It's only taken in 2 days of net inflows, which is a little bit stunning to me, given that this product was so hyped. Is there anything to extrapolate out about demand from the retail crowd, from the wealth crowd for private credit from that?
So to your point, still early days. I think the product is a little bit more complicated, a little more complex as well. It's the first kind of ETF and a private credit in one wrapper. So it's a bit early days. If we look at other strategies that have put up flows so far through the first kind of week and a half of March, they're still positive. So, you know, Blue Owl, obviously another really large player in wealth private credit, had really nice inflows in the beginning of March. So we don't really see that necessarily as a sign that wealth and retail is kind of pulling back from private markets. The ETF obviously is new and it's a bit complex, so that's probably takes a bit of time.
Alex, awesome to have you here. I hope you come back and join us again. Alex Blostein there of Goldman Sachs. A couple of headlines here coming across the terminal. Number one, Oracle, according to the information, is the leading contender to help run TikTok, which is something that we were joking about only yesterday. And then the NASDAQ 100 falling now more than 1% to session lows. You can see markets are down across the board. When we come back, we're going to talk to Regina Mayer of KPMG. This is Bloomberg. All right, 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up in a Bloomberg interview, Commerce Secretary Howard Lutnick praises the UK and Mexico while blasting the EU and Canada for retaliatory moves on trade.
Meanwhile, a government shutdown looms. Senate Democratic leader Chuck Schumer says his party would block a Republican spending bill.
And Tether emerges from the shadows. The CEO of the world's biggest stablecoin, fresh off his visit to Washington. He'll join us in just a couple minutes. All of that and more coming up. But let's take a look at these markets really falling out of bed right now. The S&P 500 down 0.8%. The NASDAQ 100 is where the pain is being felt, down 1.5%. Your biggest loser on a points and a percentage basis is Adobe right now. But you also have Amazon falling, as well as Meta, Tesla, Nvidia, Palantir. The list goes on. Unless something changes fast, it's going to be a very ugly week for these indexes, following an ugly week to start March. And then you take a look at the 10-year Treasury yield. The bond market's not really acting as a haven right now. Actually, bonds selling off a little bit. The 10-year Treasury yield, Sonali, still above 430.
You know how I feel about this. We are off that 420 mark. We are back to 430 levels. We have gone lower. Now we are edging a little higher again. I want to know the floor. I just want to know the floor, everybody.
But on stocks, I mean, we're getting ever closer to Mike Wilson's 5,500 level, right? We're going to have to look for another support below that.
Yeah, exactly. To look around the corner, we have to talk about that. Who was it that said 52? Do you guys remember?
That was JP Morgan.
Yeah, exactly. So other lows to find, but we're also going to talk about what's happening in Washington because it's driving a lot of what's going on in sentiment. Of course, Commerce Secretary Howard Lutnick had joined Bloomberg Television earlier today, and he had blasted Canada's retaliatory measures against the U.S. tariff hikes and called the moves tone deaf. Take a listen.
Take a step back. National security, we put a tariff on steel and aluminum to make sure the dumping countries of the world stop and we can build up our steel and aluminum in America. And what does Canada do? They put a tariff on sports equipment. I mean, really, this is just, it's tone deaf. Listen to the president. National security matters when he calls out things like semiconductors. He calls out pharmaceuticals. He calls out autos. These are things that matter to us as a country. And if you're going to respond to us with sports equipment, you're just not listening to President Trump.
Secretary Lutnick, how much are the conversations today actually about bringing up the negotiations when it comes to USMCA?
Well, USMCA, we set aside USMCA. So the United States made a deal with both Mexico and Canada that said if you have enough U.S. content in certain products or it's actually made domestically, they can trade between our countries tax-free. That remains intact. What is outside of that is both things that don't have that American content that are imported from other countries. So that has a tariff on it. And now the president has said, look, there are certain topics I need to have us make in America. And steel and aluminum is key. I mean, we all understand that. So why not allow the greatest country in the world, who completely feeds Canada? Canada exists, completely feeds off of the amazing economy of the United States of America. Let us build up our steel and aluminum so that we can protect ourselves. And by the way, we protect Canada. I think Canada's got 60 planes. Oh yeah, they're really going to protect themselves. They're the lowest investor in NATO. They totally rely on us, and yet they think they need to respond to steel and aluminum tariffs. I mean, everybody is so used to picking off America, so used to it that they can't even stop. Donald Trump is here to say we need to be treated fairly, and we need to be treated fairly now.
That was Commerce Secretary Howard Lutnick on Bloomberg Television just a bit earlier. And now we're getting some headlines out of Treasury Secretary Scott Bessent, who's speaking on CNBC. They're really flooding the zone here.
Yeah, absolutely. They really are. Talking about the stock market, Bessent says that the aim is long-term gains for market American people. They're focused on the real economy, and they're not necessarily worried about 3 weeks of volatility. For sure. I mean, you're supposed to zoom out. That's what we keep saying, but not exactly helping sentiment in this market, of course, with the S&P 500 nearing correction territory, the NASDAQ 100 already there, apparently not ruffling the administration's feathers just yet.
Yeah, I think I'm a little amused by this new timeline that Lutnick gave surveillance this morning, this idea that Q4 is when the data from the Trump administration will start to show. Well, don't worry about Q2 and Q3, guys. Don't worry about it.
But in terms of the markets, you have to pay attention to everything these guys say, because one comment from any secretary on any network could turn the market around or accelerate the direction it's going in. So that's what we see right now.
Keeping an eye on the prize, right? Keeping an eye on what those lows are, keeping an eye on the flows.
Of course, if you're a long-term investor, also you've got to have some resolve. But if you're a trader in these markets, and a lot of people who have Bloomberg Television on right now are traders.
And for better or worse, when we're trying to determine where the bottom is, whether it's at 5,500, 5,200, you do have to pay attention to what the administration is saying.
4,000? Who was saying 4,000?
A huge. Wasn't that Kalanovic?
Yes, it was in a tweet, I believe. Yeah. All right, let's talk to Regina Mayer right now. She is the global head of clients and markets over at KPMG. And, you know, there is, Regina, this this kind of dichotomy, right? If you're a long-term investor, you might want to try and figure out a way to get signal out of noise. If you're a trader, you have to watch every single headline that comes out of Treasury, Commerce, or whatever Donald Trump is doing in the Oval Office. How do you deal with this?
Well, I think when you think about the C-suite of corporate America, they are the long-term thinkers as well. So they need to think about long-term investments because they're making capital allocations that could be 5, 10, 15 years from now. So I think they're really struggling with some of the uncertainty and volatility. Some of the data points that I'm tracking, the Global Economic Policy Volatility Index is at an all-time high, beating the pandemic peak. The US version of that index is at the second highest level. We did get some really interesting or positive inflationary results, but we expect that real GDP, the economists are predicting it's only going to grow by 1%, which is less than half of Q4 of last year. So we're seeing a slowdown.
we're already seeing wholesalers increase intermediate prices, which will have an inflationary impact. And what my C-level clients are telling me is they just are craving certainty. I think the traders can thrive on volatility. I think long-term investors are trying to weed out the noise from the real signals. And that's what it's like to be a CEO in America today.
Right, the signals coming out of Washington. How do you pay attention to exactly what matters in terms of the rhetoric coming out of the Trump administration? Another headline from Besant this morning as well was on the government shutdown. He says that it would be incredibly disruptive, and he's not the only one that feels that way, particularly with Doge, Regina, when you think about how many people are being laid off from government jobs already. How does the rhetoric in Washington, that push-pull between what's happening with the U.S. budget, creating uncertainties that actually might not be day-to-day, that could be longer term?
Absolutely, and I think that's where industry is trying to head. We want to have a better understanding of what is the strategy. So we can deal with tariffs, we can deal with changes to Doge, we can deal with rulemaking and regulatory policy, but we just need to know what it is and what direction are we going in. And I think that the movement back and forth and some of the switcheroos of day to day it's this and the next day it's that is creating market uncertainty, which is damaging consumer confidence as well as investor confidence, which we will probably see trickle into the economy. There are some really positive signals, right? Some of the executive orders that are now moving into agency rulemaking on deregulation are being embraced by many across the business community. You even see the EU responding with its omnibus legislation to really slim down some of the climate change regulations with CSRD and CSDDD, the alphabet soup of regulations they were facing. That's all going to be long-term positive. And I think the C-level clients that I've been interacting with are trying to stay focused on that and trying not to react to the day-to-day. One very senior financial services executive, I think he's taking it upon himself personally to try to calm everybody down. It's the equivalent of everybody just calm down.
Regina, how reliable is that alphabet soup of gigantic European bureaucracy? We hear even from progressives in Germany that they want the EU to calm down a little bit, to dial it back in terms of the ESG regulation specifically. Can you bank on that staying in place if you're a CEO, or can you start to spend less money on that?
We definitely think it's a lot more pragmatic now, and they've delayed some of the timelines for implementation. So it's a lot easier to figure out exactly what you need to do. The number of data points that you have to report against has been radically reduced. The timeline for compliance has been lengthened. The number of companies that it will affect has been reduced by 80%. So I think that's bankable. And there's a level of pragmatism that's coming into the whole conversation, including in the sector that's in my backyard here in Houston, big event this week. All of the permitting regulation, there's a lot of positive momentum in many industries that we're going to have a pragmatic approach to what do we need to assure good outcomes, but also make it easy to implement and not capital intensive.
Regina, we thank you so much. Regina Mayer of KPMG, parsing through all that noise. And one thing I've been thinking about, Matt, is you were talking about that trader mentality. A trader at a large hedge fund pointed out to me the other day that one thing that's particularly hard for a lot of people that are navigating these markets is that still for most of their career, they've navigated either a one-way market with not too much volatility, with next to zero interest rates. And the last couple of years, let alone this one, has been a one that has not been what's made their careers.
Well, and we've heard from Joe Doe a couple times this week that the traders he talks to, of course, they're metals traders, aren't comfortable getting into this market right now. And they make money on volatility. They should love swings. Right. But when it's too volatile, they don't want to get burned.
It really applies to almost every asset class you can think of. We're talking about stocks, we're talking about commodities. You think about currencies, for example. I was a currency reporter for 2.5 years back when the dollar didn't move. There was no FX volatility. So there's a whole generation of traders who are learning how to handle, like you mentioned, Sonali, two-way markets.
And what I love watching, it's funny you mentioned that, it's like we're vibing right now because I have the dollar on my screen and just how much it's given up since November is stunning. Anyways, ride that volatility,
I'm
guys.
looking at it, by the way, check it out. With the annotate button on your screen, you can go to the top of the chart and come down. We're down 4%, and that from just the beginning of the year, so.
Tell us, folks, if you're still long that dollar and how much conviction you have in that trade. Anyways, we'll talk more about it. Coming up, we're going to switch gears because the Senate Banking Committee, speaking of Washington, is set to vote today on stablecoin legislation. This is a big move in the world of crypto, so we're going to bring in the CEO of Tether, who has a lot at stake as lawmakers move to regulate the sector. We're going to talk to him next. This is Bloomberg.
Let's get now to high interest. Look at what's making headlines around the world. The U.S.-EU trade war is escalating. President Donald Trump threatening to impose 200% tariffs on wine, champagne, and other alcoholic beverages from France and the EU. The president said in a post on Truth Social today that he would move forward with levies if Brussels follows through with a tax on American whiskey exports. That measure was part of the bloc's retaliatory package against Trump's steel and aluminum tariffs that went into effect yesterday. Harley-Davidson also one that they want to hit. And President Trump's Middle East envoy, Steve Witkoff, is heading to Russia this week to present a 30-day ceasefire proposal to Vladimir Putin. The U.S. agreed an accord with Ukraine to lay the groundwork for an end to the war, at least a ceasefire, after talks between both sides in Saudi Arabia. Bloomberg reports Putin will probably agree to the truce eventually, but may drag out negotiations to ensure that he wins concessions made first. And the two NASA astronauts stuck in space will have to wait a little bit longer to get home. A launch pad problem caused SpaceX to delay a flight to the International Space Station, which was intended to retrieve those two. The new crew needs to get to the ISS before Butch Wilmore and Suni Williams can head home after being in orbit for 9 months. Sonali.
Now we're going to go away from space and back to reality here on the ground and down to Washington, D.C., traveling a lot around the planet. Anyways, the Senate Banking Committee today is set to vote on regulations for stablecoins. The bipartisan deal is aiming to protect consumers and expand financial inclusion. The opposing arguments say the bill falls short of meeting those goals. For more, we're joined by Paolo Ardoino. He is CEO of Tether, which is the world's largest stablecoin issuer here. He joins us fresh off of a visit to Washington. When you looked at the movement, arguably the stablecoin bill, the rulemaking around it, is one of the biggest things to happen in the world of crypto in the United States. What do you think this bill ultimately does? To the extent that it gets passed, what does it unlock for you?
Well, first of all, thank you very much for having me. This bill will unlock very much clarity on the stablecoin role for the future of the US dollar hegemony and how it should be managed in a very safe and serious way. So we are very excited because, as you know, Tether is the company that created the stablecoin industry in 2014. We issued the first stablecoin that's called USDT, and we have the biggest user base when it comes to stablecoins across the world. We have more than 400 million people using USDT in emerging markets and developing countries, and we are growing at 40 million new wallets per quarter. So the fact that our technology is being now subject of huge interest also from the Treasury and the president himself, it's very important to us. We want to just make sure that we are heard because we represent the biggest use case for the digital US dollar represented by stablecoins in the world.
And Paolo, while we're on the topic of Washington, D.C., you recently posted a photo of yourself at the White House. Were you actually in attendance at the White House Crypto Summit?
No, I wasn't not in the attendance of the summit, but that was my first trip in the United States ever. And I'm very thrilled to be here, and I love the country. So, I had to do a little bit of photo taking around the Capitol.
I get it, tourist stuff. I've taken a few photos like that myself. But I am curious, while you were in the vicinity of the White House, did you meet with any lawmakers?
Absolutely. We have been having different meetings with lawmakers and the administration. It's very important that our voice is properly heard because, as I said, we represent the most important use case for the US dollar hegemony around the world. We build kiosks in Africa that facilitate the usage of USDT and so US dollars. We work with bodegas in Central South America. We are present with boots on the ground, building infrastructure for the US dollar from the ground up in all the emerging markets. And the interesting thing is that there is Tether there, and basically there are the BRICS. And I believe that USDT in this moment is representing the last stronghold in support of the US dollar in the emerging markets, when everywhere else we're seeing a very big push for de-dollarization of the world coming from the BRICS nations.
Paolo, I am pretty stunned to hear that you had not visited the nation's capital, let alone had more of a presence in the United States. I understand that there has been a fits and starts relationship, but you also have had a very strong relationship as Tether with the current Commerce Secretary's, I guess, former firm, now the firm he founded, Cantor Fitzgerald. What is your relationship still like with Lutnick and currently with Cantor as that relationship has been expanding? And what does that relationship give you in terms of insight into the future of crypto in this country?
Well, our relationship with Cantor is very strong. We are very grateful to the fact that they onboarded us in a period when the past administration in the United States just tried to almost kill crypto, right? You remember Operation Choke Point 2.0 and the rest. And so Cantor took the time to have and do the deepest due diligence on Tether that is inimaginable. And they got comfortable with us. They decided to onboard us and allow us to keep all our treasury bills with them. So we are very grateful, and we work with them as partners because they understand the institutional space in the U.S. like no one else.
Well, when it comes to the future of that relationship, Bloomberg News had reported that you were in talks with Cantor to join in on their lending partner, on their project, rather. Is that partnership still underway? Is that something that you might tack onto?
Well, Bitcoin lending is very interesting to us and very important. I believe that there are huge opportunities, and joining forces between Tether and Cantor is the right thing to do. They know all the institutional borrowers, and we are the leaders in the space of tokenization on assets, and also we are among the biggest companies in the Bitcoin space. So it just makes sense.
Paolo, I just wonder why you're based in El Salvador and spending time in Switzerland when you have a U.S. dollar stablecoin. You have a U.S. flag there on your lapel. Why don't you do your work out of the United States of America if the underlying asset is our dollar?
That's a great point. But, the reason is that if you go outside the U.S. and you meet 1,000 people in the streets, and you ask them, would you prefer to hold the US dollar or would you prefer to hold your national currency? They will all choose dollar. So actually in the US, you have 15 ways to pay people around, right? You have Zelle, Cash App, PayPal, you name it, debit cards, credit cards. You can take loans out of credit cards. You have bank accounts. You have 95% of the population that is banked. Outside the US, there are 3 billion people that are called unbanked or underbanked. They don't have access to standard financial systems. They don't have any ways to pay, and they're desperate to have the dollar. Right. So as any company, you have to find your product market fit, and that is the unbanked for us. And we created a great business that is helping the United States buying back all the T-bills that we can. We have more than $115 billion in U.S. treasuries. We are 19th largest country. We are not a country, of course, and holding T-bills.
Unfortunately, we have to leave it there. As you can hear, we're up against the clock. Really enjoyed this conversation, though. That is Paolo Ardoino of Tether. This is Bloomberg. Welcome back to Open Interest. You take a look at markets right now. That sell-off we've been talking about lessening a little bit. The S&P 500 still lower, but coming back, especially when you take a look at the NASDAQ 100, now down just 0.3%. Now coming up, U.S. small business optimism falling to a 4-month low. We'll get reaction from the CEO of Xero next. This is Bloomberg. Well, U.S. small business optimism falling to a 4-month low. The latest NFIB survey showing that business owners are feeling uneasy about potential tariffs. Owners indicated that they will pause investments as they assess the policies of the Trump administration. For more, we're joined by Sukhinder Singh Cassidy, the CEO of Xero. Xero provides financial tools to more than 4 million small businesses across 180 countries. Cassidy, also the former president of StubHub and the founder of Joya, so really a wealth of experience when it comes to the tech industry. But let's talk about small businesses and take the pulse here, because you take a look at the data and it seems like we're starting to see some trepidation. What are you seeing from your vantage point when you talk to your clients?
Well, first of all, to come back to the data at hand, of course, you're seeing a decline, unfortunately, in overall confidence and an increase in uncertainty. And I would say right now, from a financial resilience perspective, what we see across our client base, I would say, is both strong financial resilience. And yet, I think that globally, this uncertainty is starting to affect how people think about managing their financial appetite and risk. And I would say, as you know, that's not just small businesses, that's all the way to larger businesses. But we have small business owners who are also consumers and, see what's going on in the macro and are really kind of thinking about how they manage their financial capabilities through this period of uncertainty.
Coming into this year, there was this perception that maybe tax cuts, other policies would help smaller businesses, maybe in a disproportionate way. But you can see between the optimism fading, as well as prolonged high prices in certain categories, there has been a lot of pressure on the small businesses in the United States in particular, but certainly even abroad if you think about those tariff pressures. So what is the difference? What are the unique challenges that small businesses are facing relative to large ones right now?
Well, first of all, here's a big one: cash flow. Okay, so we talk about uncertainty about the future, and we talk about, of course, how they think about labor costs, inflation. Yes, we can say all businesses think about this, but the unique challenge that small businesses face is cash flow. We've been running our own surveys for, almost all of Xero's existence across all of the countries in which we operate. We operate in, 8 large countries and 180 others, and what we find is consistently small businesses get paid late. And so in a period of growth, cash flows might be up and you may be able to manage that. In a period of uncertainty, late payments and cash flow is the single biggest problem that small businesses uniquely face. By the way, it persists. It's the #1 complaint our small businesses have across the world. The second, not surprisingly correlated to you all, is labor quality and cost of labor. And then, of course, uniquely for small businesses, and this is where something like Xero comes in, it's how do you digitize and level the playing field, not just when it comes to cost of capital and other things, it's even access to technology. And we think our job is to help those small businesses manage payments, manage spend, thrive, increase profits through the proper use of cloud-based financial tools.
Sukhinder, what about manufacturing? What about the supply chain? Obviously, this is part of Donald Trump's push. He wants to end, fentanyl coming across the Canadian border, but he also wants to bring production back to the U.S. And we have a great story on the Bloomberg terminal by Daniel Taub about Electro-Harmonics, which is a New York-based maker of like wah-wah pedals that Jimi Hendrix used, that Nirvana used. And the founder, Mike Matthews, says, there's a great picture of him here, he just can't make his materials in the U.S. He's a small business. He has to continue to buy stuff from overseas. And he says, if you're a billion-dollar company, maybe you can move your supply chain, but for small and mid-sized businesses, can't do it.
Well, I think you're hitting exactly the point that is correlated, the earlier point on payments and payment flows. So to your point, if you think that small businesses are at a disadvantage in these areas, then supply chain disruption really has the potential to do 2 things that are very difficult. Number one, it increases the bills they pay out, very simply put, their spend to produce their goods. And on the other hand, if those same, supply chain disruptions lead to an increase in the cost of goods to their end consumer, demand can potentially get stifled. And so they get hit on the other end with higher prices leading to lower demand. So I think that this fear, we all hope that certainty will come. We know that businesses, big and small, like certainty, and we will see what happens in the global macro. We think our job, of course, is to help small businesses navigate this period, because cash flow management coming all the way back and financial literacy are more important than ever in times of uncertainty and disruption.
want to talk about the labor picture a little bit. There's a lot of questions over what this downsizing of the federal government led by Elon Musk will mean for the economy and for the businesses, the small businesses that you work with that also work with the government. Do you see any impact there?
Well, I think there are two potentials. Now, first of all, as we talked about, I think many small businesses have hoped that this will be a deregulatory environment. Let's see what happens on the tax side longer term. But if you think about the other thing that they may be affected by, it is many of them have government contracts. And so I think as the government sort of becomes more efficient, and look, many business leaders are, and I would say nationally, many Americans are fans of obviously smaller government. But when we look specifically at the potential for small businesses to lose government contracts, that may be another area of concern that they need to watch.
When we think about what is happening in Washington and the ripple effects, they're massive. You worry about a potential shutdown. You worry about changes in tax policy and how it would impact small business in particular. You worry about hiring. You worry about inflation. What does this mean? You mentioned cash flow a little earlier being a chief concern. Small businesses in the United States have typically and historically been the greatest source of job creation in the United States. How do these Washington-based inflows, or the decisions based in Washington that will impact flows, impact the hiring propensity for these companies that need to also spend money on other things?
Yeah, well, look, they're two correlated but different points. First of all, if you look at the index, it counts labor cost, interestingly, as one of still the topmost concerns for small businesses. We know that this has been an ongoing concern since COVID, actually. So I'd say on the one hand, labor costs, I think, are very high. On the other hand, how much they can afford to hire will be directly correlated to their ability to, again, manage their cash flow and to demand. So I think you have two interrelated factors here. They're signaling in the index that really labor cost and the high labor costs continue to be concerned, and yet we may see an environment here where if uncertainty continues or persists, they throttle back spending in all areas, potentially including labor, particularly if there's not only supply chain disruption, but any pass-through of costs to their own consumers or buyers who then lower their demand. So look, all things to watch. What they, like others, are hoping for is certainty. What we hope to do always is help them manage through this period. We did it in COVID. We think it's essential that small businesses digitize, take advantage of this kind of tool set to really understand what's going on in their business and manage through these periods of uncertainty.
Well, such an interesting look at the small business community, really the foundation of the American economy. Hope to speak to you again soon. That is Sukhinder Singh Cassidy, the CEO of Xero. Meanwhile, let's get a check on these markets right now. Still lower on the day, but less so. The S&P 500 off by about 0.4%. We were looking at 0.9% lower earlier in the session. Similar story if you take a look at the NASDAQ 100 with big tech off by about 0.8% right now. It's shaping up to be a very, very ugly week for these indexes, and the bond market no help in your 60-40 portfolio, with the 10-year Treasury yield higher by about 2 basis points, back above 430 as we keep mentioning.
Man, what is investing today? Anyways, we're going to look at stocks moving this hour with Bloomberg's Isabel Lee, because, of course, we're keeping some eyes on at least one particular high flyer in the market. New CEO at Intel, the market seems to like it.
Shares are jumping as much as 18%. That's the most since March 2020. And there is a new CEO, Lip Bu Tan. So the 65-year-old Malaysian-born, Singaporean-raised executive will take the helm on March 18. So he's also rejoining the board. So what do we know about him? He's a former Cadence CEO, and he's basically just tasked to restore Intel to its former glory. Intel has been an industry laggard that failed to jump ahead of its rivals, and Wall Street likes it. Bank of America upgraded shares to neutral. They said that he has a solid track record. Cantor also said he's a solid choice. Bloomberg Intelligence said he has a strong track record. So this is not usual for you to see Wall Street really embracing a CEO like that. And he's not no one really knows him outside of the industry, but he seems to be a really strong contender within.
Right. Well, it's like someone said, if he can't do this job, no one can do this job. And I have a feeling maybe no one can do this job.
Well, we'll have to see. He also has a rich history with Intel. He resigned from the board in August 2024, and he's back already. So there you have it.
Let's talk about American Eagle. Those shares are getting hit today, and I'm looking at the ticker. Price targets are getting cut at JP Morgan, TD Cowen, Telsey, UBS. The list goes on. So what's wrong at American Eagle?
It does go on. So the retailer's forecast operating income missed estimates. So again, it's an example of how weak forecast overshadows an earnings beat. So get this. So the operating income they predict for the first quarter of next year is 20 million to 25 million. The estimate is 85 million. And the capital expenditure they expect is 300 million. The estimate is 232 million. But their results right now, net revenue came in line with estimates and etc. But still, it's really the outlook. And we have Bloomberg Intelligence pointing out that they source almost 19% of their finished goods from China and 20% from Vietnam. So they're also probably also concerned about tariffs and the implications for their company.
Yeah, more bad news for those shares, down about 31% on a total return basis year to date today. Obviously isn't helping, but let's end with a happy note. Let's talk about Dollar General actually managing to put up some good numbers, and you can see the stock reacting as well.
Which in itself is concerning, by the way.
I know.
No, I'm smiling because I've never been to a Dollar General, and before I stepped here, I Googled Dollar General in Manhattan, and there are only 3, I think. So I'm justifying
But there
my
are
behavior.
Dollar Generals on Manhattan, on the island?
If I'm Googling correctly,
Yeah.
I
We should
saw.
go. Interesting.
But, field trip. Anyway, so the retailer predicted sales to grow, and within a higher range of what's estimated. The company said comparable sales will gain as much as 2.2%. That's in contrast to the 1.8% estimates. And it's really interesting because we know that big box retailers like Dick's Sporting Goods and Macy's have really struggled, including Walmart. But then we have the company saying they plan to open 575 stores this year, topping the 20,000 they did last year.
You know, guys, we were talking about small businesses. I've been looking at Dollar General and Dollar Tree, both over on a year-to-date basis. Dollar General now up on the year, while the S&P is still down. But on a one-year basis, I think it really just shows you how much concern there's been around the lower-income U.S. consumer, because even the dollar stores have been struggling. I mean, just check that out. It looks ugly.
It's all, by the way, concerned about the higher-end consumer as well. It's across the kind of wealth spectrum. You're seeing bank balances that are lower year to date or over the last 12 months than inflation-adjusted 2019 levels. You're seeing wage growth that's slowed for all income groups, according to the Fed of Atlanta. And you're seeing inflation-adjusted debt going higher than pre-pandemic levels. So,
well, the question for investors increasingly is who benefits from the trade down? You are seeing that trade down materialize once again.
Cui bono,
Walmart
Katie.
for a while.
Cui bono.
I don't know what that means.
That's who benefits in Latin.
Okay, that's cool. All right, we learning a lot here.
We'll go to Dollar Pizza also after.
Oh, yeah.
Dollar
Good
Pizza?
point. Would buy stock in that. Anyways, Isabel, we thank you so much for your time here. And Matt, coming up, we've got...
5 years ago, leaders had to make a tough call on how to handle the pandemic. In today's Wall Street Week, we'll take a look at the international response to COVID-19 when they shut down the global economy. This is Bloomberg.
All right, it's time for our Wall Street Week conversation. And when COVID-19 hit 5 years ago, some countries implemented strict measures to stop the spread, while others took a softer approach. Bloomberg Wall Street Week host David Weston explores the international responses to the pandemic and how it impacted the global economy.
As a Swede, I felt quite attacked and harassed during the pandemic, and both foreign friends and media constantly got in touch asking me, are you all crazy over there in Sweden? And we got it from all sides of the political spectrum as well. People saying that Sweden is a cautionary tale. I read that in the New York Times. And President Donald Trump at the time said that, look, Sweden is suffering tremendously. Hundreds of thousands of Americans would die if we do what the Swedes do. So we were basically not very popular at that time, and it felt like we had to defend ourselves. I think many people had a vested interest in explaining the Swedish model a failure before we saw the results.
And the results, as it turned out, were better than expected. Johan Norberg is a senior fellow at the Cato Institute. His report on Sweden's pandemic response found that where models forecast a death toll of more than 80,000 by July 2020, Sweden had suffered fewer than 6,000 by that point.
The other aspect is what the Swedish Public Health Agency said. Yes, we might have more cases and deaths early on in Sweden, but this will even out in the long run because no country can completely shut itself off unless there are tiny island far away from everything. And this is exactly what happened. If you look at total cumulative excess deaths during the whole pandemic period, Sweden came out with one of the lowest excess death rates all over Europe, and less than half of the excess death rate of Britain and the United States. So I think in the end, when we look at the numbers, when we look at the data, I think even some of the opponents of the Swedish model would say that, yeah, we didn't risk people's lives. In fact, it worked out better than in most other rich countries.
Half a world away, New Zealand took yet a third approach. It locked down its borders and implemented strict lockdown measures to avoid community transmission, suffering just 25 deaths from COVID in 2020. But it meant the country was effectively shut off from the rest of the world. Sharon Zollner is the chief economist for New Zealand at ANZ Bank.
It was chaos when COVID first hit, of course, like it was everywhere. Massive uncertainty about what was going to happen. We saw a crash in business confidence. We saw monetary policy ease dramatically. And of course, we had the wage subsidies rolled out very quickly. Of course, inevitably, it was a bit slapdash. But I think probably the single biggest forecasting mistake we all made, the government, the Reserve Bank, private sector, was underestimating just how effective those wage subsidies were going to be.
And that was David Weston on how countries took different approaches to handling the pandemic. You can catch Wall Street Week every Friday at 6 p.m. Eastern. Now coming up on this program, Shutdown, Showdown. The Senate has until this weekend to keep the government open. More next. This is Bloomberg.
Funding the government should be a bipartisan effort, but Republicans chose a partisan path, drafting their continuing resolution without any input from congressional Democrats. Because of that, Republicans do not have the votes in the Senate to invoke cloture on the House CR.
Senate Democrat leader Chuck Schumer there saying his party plans to block a Republican spending bill, leaving the door open to a government shutdown this weekend, if he can hold his party together. For more, we're joined by Bloomberg Balance of Power Co.'s Kayleigh Lines in Washington, D.C. Kayleigh, I see that it looks kind of like John Fetterman has already jumped the aisle, right? So there must be other moderates who are going to vote for Republicans.
Yeah, Democrats are in a really hard spot here, Matt. They don't want the government to shut down, in part because they're fearful of what that might actually give the Trump administration and the Department of Government Efficiency under Elon Musk. If they shut down federal departments that might never be open or not have an easy path to do so. That said, they also are very resistant to this particular continuing resolution and the areas in which funding will be pulled back, which is why Chuck Schumer, as we just heard there, is threatening not to allow this procedural motion, a cloture vote, through. 60 votes are required to do that. And of course, Republicans only hold 53 seats. So it would take a lot more than just John Fetterman to get to that 60 vote threshold. What Chuck Schumer is pushing for instead is a 1 month long continuing resolution that would keep funding through April 11th. It's possible that he and the Senate Majority Leader John Thune could come to an agreement where Democrats get an amendment vote on that particular measure, which of course would fail, and then agree to provide the votes necessary to invoke cloture and avoid a government shutdown. But really, a lot of this just comes down to the gamesmanship and the showmanship of Democrats wanting to show that they are resistant to what Republicans are currently doing in Washington.
I mean, who are some of the key figures that you're watching in this holdover? Because ultimately, there are people who are watching market impacts, which is absolutely fair. Of course, if this tends to be something that brings things to the brink, we have seen issues in the past in markets. But what about the longer term view of the parties? Because people already have midterms on their mind.
Yeah, 2026 is not all that far away, Sonali, and there are vulnerable senators who have to bear that in mind. Think Senator John Ossoff in Georgia, a swing state, who is going to have difficulty holding on to his seat. He might not necessarily want to be party to a shutdown, but there's other moderates as well who have suggested that they really don't want to be complicit in allowing the government lights to turn off, especially given the intensity of this particular environment and the concerns around the Department of Government Efficiency. Again, if federal workers are laid off or furloughed, there is a risk that their jobs may not come back based off of the way things are going right now, especially considering this coincides with today, a deadline set by the White House through the Office of Budget and Management under Russ Vought, as well as the Office of Personnel Management, which is essentially the government's HR department, for federal agencies to outline massive reductions in force. It's not clear exactly what those numbers will look like, but we could well end up in the hundreds of thousands of federal jobs that will be lost, and a shutdown would just add to this pain, especially regionally here in the D.C. area.
Kayleigh, I have a much longer-term question for you, and that is this government going to manage to extend the Tax Cuts and Jobs Act of 2017? Because I think there are a lot of people, bear with me, who would be better off with no more SALT cap than, 2% lower tax rate.
Well, Matt, the SALT cap is one of those things that makes that answer to that question very tricky, because this is going to be difficult to do, because Republicans are planning to pass the tax package along with the funding they want for the border and energy policy through just a party line, a budget reconciliation vote. They would have to have effectively every single member of the Republican conference in the House specifically vote for that. Only one vote realistically might be able to afford to be lost. And it's very hard to reconcile all those different differences. The idea that people from states like New York or California, Republicans there, do want to see the SALT cap lifted, that's not necessarily popular everywhere. This is going to be a tough battle, and it's likely going to require some arm twisting from President Trump, who is necessary to just pass this continuing resolution.
To be clear, Matt is asking for a friend, and his friend is named Matt. Kayleigh Lines, it's great to see you. That is Kayleigh Lines joining us from Washington. That does it for Bloomberg Open Interest. We'll see you tomorrow on Friday. This is Bloomberg.